the first thing, as I was talking about, this is one of the things that everybody talks about. Let your profits run and cut your losses. Does it really happen this way? Let's take an example. Usually happens the other way around, absolutely the other way around. Let's say that for some reason you have, let's take this particular example right here. This is a double top. You have entered short based on double top. Or no, this is not a good example here. No, I just want to go over something. Let's say that you fail somewhere. This is a double top, right? This is a double top, and you have entered, as an example, that you have entered short where price bounces off a resistance zone second time and go. You've placed your stop somewhere above this, your expected target for whatever. Let's say that you're looking at the next zone of support resistance. Let's put it a little down. Right, this becomes a nice, wherever the price has resistance which turns into support, turns into support. So what you're expecting is price to move down over here. You've placed your stop here. Now what happens is price generally, for whatever reason, maybe you've misread it, maybe something had happened, price moves up, moves towards your stop loss level. And then you think that, oh no, there's something over here, this is looking good, it could be just some kind of a price movement. What I'm going to do is I'm going to give it some breathing space. So I'm going to put my stop over here. So what you do is you increase your stop. So you are letting your losses run. Price moves in your favor, say, oh see, good, I was smart, and then prices move up again. And once it moves up again, then you increase it slightly more. Or this looks like a good technical level, price is not going to go above this. You try to convince yourself. Happens a lot. And before you know it, your loss of maybe about $50 or $100 turns into $500. You've let your losses run. And this happens a lot. So one of the first lessons of a trade plan or executing a trade plan is do not move your stops against you. Move them in your favor. For whatever reason, if you have placed a stop, if you have put a stop loss level, have the discipline to stick to it. Conservation of capital, remember that. Right? Now, let's go over a trade plan example. I just want to go over one particular divergent trade that we took, and I want to use that as an example of a trade plan. Let's zoom it inside. This is a bearish divergence. If you look at this, price made high and a higher high, and if you look at your stochastics, they made a high and a lower high. Classical textbook example of a bearish divergence, what we call as a class A bearish divergence. Now the trade plan, when I'm talking about a trade plan, if I was trading this, when I was trading this, we had a trade plan for this. Now the first thing, of course, I follow a couple of systems or 3-4 different techniques. I'll look for harmonics, I'll look for a divergence. But if you have one trade plan, I would suggest sticking to one technique, maybe two for that matter. That I am going to take a trade, let's take example of a divergence, only if I see a divergence. If I do not see a divergence on whatever time frame I'm looking at, maybe 5 minutes, maybe 15 minutes, maybe 1 hour, I'll scan my currencies. Let's say I'm trading intraday and I'm trading on the 15-minute time frame. On the 15-minute time frame, I'm sitting there and I scan my currencies all day long on the 15-minute to look for a divergence. These conditions for a divergence, where price makes a higher high, the stochastics make a lower high. Right, a bearish divergence. If I do not come across any divergence, I will not trade for the day. Very important. Let the price go wherever it wants to go. Suddenly the euro drops 300 points and I think, oh, I have missed out on the trade. No, you ask yourself that, was this as per your plan? Was there a divergence which moved that? No. If not, you are not supposed to take part of it. There will be more opportunities in the market. This is not the only move. Now this is very, very important, and a lot of traders cannot follow this, human emotions being what they are. But this is the beginning of your trade plan. Decide on a strategy. Say that only if these conditions are fulfilled will I take the trade. If I do not have these conditions, I will not trade. I will not trade for a day. I will not trade for 3 days. I will not trade for a week if required. But only if the conditions are satisfied, or if I get my setup, I'll trade. Now see, what happens here, folks, is in the process what you're doing is if you're waiting for the conditions, your setup conditions, you are eliminating more than half of your unsure trades. This increases the probabilities of success. Obviously, once the setup conditions are there, your probability of success increases. Right, so what did we decide on a trade plan? Have a strategy first, have a technique. Then you decide on your entry, exits and stops. So here we decided on entry, exits and stops. Let me just go through this. Your stop obviously was placed above this high. Your expected target for this trade, we use the Fibonacci's, we use the Fib 127, Fib projection 127. This was a Fib for projection 127. The entry was based on a combination of different factors, but let's just put it, if I remember correctly, it was somewhere below this bar, little over here. Right? This is what the trade was. You have the entry, you have the stop, you have the expected target. This gives you your risk to reward ratios. Obviously, your risk for this trade was about 40 odd points, and your expected reward, you don't know whether it's going to happen or not, was about 150. Risk to reward ratio of about 1:3, little more than 1:3. Excellent risk to reward ratio. Ray, I'll just come back to that. It's a very interesting question. Right, so you got your risk to reward ratios. We decided on the number of lots that we were going to trade on here based on the capital, that okay, I'm going to trade 3 lots, I'm going to trade 4 lots, mini lots on this. We enter the trade went forward. Now, very important point is what I generally do is we enter with limit orders. We do not enter with market orders. So we place the entry at that place that if price comes there, we are filled into the trade. Preferably don't want to go in with market orders. You place your orders there, price fills it, you're in the trade. Your stop loss levels are in place, your targets are in place. Once you're filled, it is your trade management. Your trade management is very, very important. See, what happens in this case, price went down, reached a certain level and bounced from there. It pulled back from there, almost back to the entry level. But there are certain techniques that we follow. We were expecting that price will move up from here, and if it stops over here, we are still in the trade. Took some profits over here because this was a pullback point. Took some profits right over here. Let me just remove this. Close some profits over here. Shifted stop down almost to your entry level, close to your entry level. Waited for the pullback, still in the trade. Price did go down in a favor, which we were expecting. Now, not all trades really work out like this. And it's not that we were lucky. We were prepared for this trade. Because we knew the certain levels that yes, price is expected to bounce from here. If it pulls back, this is the certain level that if it stays within this level, we are still in the trade. If it goes beyond this, if it would have gone slightly above this, obviously we would have got stopped out since we have shifted the stop, but we would have got out of the trade saying that something's gone wrong. Now, trade management is very important. So expecting, the point is this move up against us did not freak us out. For a new trader who enters a trade for some reason, and he doesn't have a reason, and the trade goes in your favor for some time, and once it starts pulling back, price always moves in waves. The trader freaks out, literally. So, oh, something's gone wrong, let me get out of the trade. He gets out of the trade, and in effect what you're doing is you're cutting your profits. Right? If I would have gotten out of the trade over here, I would have missed out on the balance profits. So what am I doing? I am cutting my profits and letting my losses run. Exactly opposite of what you're supposed to do. So this is how the trade was executed now. As I said, this was a pictured bearish divergence. I just want to go over these examples. Very important to have a plan. Decide on a strategy. Decide on your setup conditions. Decide on your technical levels. Expect price to move up and down. And manage the trades. That is the essence of a trade plan.